Well, folks, the EV startup industry is getting absolutely destroyed by the stock market. Investors seem to have lost almost all confidence in a number of different electric vehicle startups that went public over the past few years, whether it be Lucid Motors, Rivian, Nikola, Hyliion, Hyzon, Mullen, or even Proterra. These companies are struggling. Now, perhaps their businesses might be performing okay for the turbulent economic times that we're in today, but their stock prices are showing a completely different story. After the massive bubble that has blown up Tesla over the past few years and created a very big hype around electric vehicle companies, people rushed towards investing in other such companies. That led to an IPO frenzy where companies even went public through SPACs as a method to getting to the public markets as fast as possible at the expense of minority shareholders. And it seems like we are today reaping the consequences of that hype. What exactly are those consequences, and why are EV startups getting pummeled in this economic environment? Those questions are exactly what I want to address in this video. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, I want to explain why I'm making this video in the first place. Obviously, I'm passionate about electrification, decarbonization, and the energy industry, and electric vehicles play a very key role in the decarbonization race. But what has happened over the past 6 months or so specifically has really shook a lot of confidence in the ability for some of these companies to actually turn a profit. And although in the startup space that should be expected given just how difficult the auto industry is, rising competition from traditional OEMs and also the economic turmoil around China, higher interest rates, and a slowdown in economic growth in the US at least, is creating a lot of fear around electric vehicle companies, not only from a delivery standpoint, but from a production, cash burn, and at the end of the day, investing standpoint. And today, as of the filming of this video, we got new data from two of the hottest EV plays by the name of Rivian and Lucid Motors, which has really set the nail in the coffin for what Wall Street had been pricing in so much. As you can see, this is the investor deck that Lucid Motors, for example, shared before their IPO in 2021. In 2023, you can clearly see they estimated that they would be delivering around 49,000 vehicles, based obviously on the expectations of where the economy would have headed in 2021, not in 2022. And well, surprise, surprise, as you can see, they delivered just 1,400 in the first quarter, which means there's a very, very slim chance they hit their 49,000 production and delivery target for 2023. And that was not all. Today we also learned that Rivian's most bullish analyst from Piper Sandler just cut its price target by 75% for Rivian stock from $63 down to $15. But to be honest, I don't think that's why this Rivian news is so important. What's more important is what this price target downgrade shows us about the sentiment in the stock market right now. And it is summed up pretty well with the statement that the analyst wrote in his target review, where he said that, quote, "In this market, frugality matters more than ambition." Frugality matters more than ambition. If there was one quote that summed up the 2022 bear market, I think it would be that quote. Because the simple idea is when the economic table turns to the downside, when interest rates go up to the levels we have not seen since the last global financial crisis, investors have a massive shift in their risk appetite and what they prefer to pick, even if you have some of the most innovative companies in the markets today. And unfortunately, you can see the repercussions of that very clearly with the performances of some of the publicly listed EV stocks. These stocks are down anywhere from 56% down to 74%. This is obviously a massive destruction in the valuation of companies that are some of the most ambitious in the entire technology and engineering space. But as we all fail to realize sometimes, when interest rates go up, the market's time frame goes down to just 12 months. Warren Buffett said it best: be fearful when others are greedy. And we clearly saw that happen in 2021. Greed was the name of the game in the stock market and even the venture capitalist world. As people were getting richer and richer, wages were going up, innovation was at a high given just how much productivity increased from work from home, and obviously companies were flush with cash for capital spending and growth. Every single company and executive in an EV industry sounded like a genius back then. It wouldn't matter what the financial situation of the company would be. Venture capitalists and investors in the public markets were willing to throw every dollar at these businesses. And that was the sole reason these companies were even able to go public back then, raising money from not only the banks, but also massive institutional investors. Because what people realized is that the total addressable market, or the TAM, for the automotive EV space is truly huge. The global automotive market is worth more than $800 billion, and even if a company can acquire 2 to 5% of that share in the US, the company can pull in revenue north of $5 to $10 billion. And if you strap a decent automotive PE ratio, these companies are going to be worth 10 to 20 to 30 billion dollars. That led to investors bidding up the prices, and that is exactly what led to the bubble that we are seeing today unfold in front of our eyes. And obviously, every EV stock that went public over the past few years went public at its own discretion, whether that be timing the intraday or intra-week cycles of the stock market, timing various fiscal or monetary bills, or timing the election of 2020, where Biden, with his pro-EV and pro-clean energy investments, would get elected. Every company in this space had its own agenda to take its company public at the most optimal time. Now, obviously, don't get me wrong. What I'm telling you so far is what has happened in the past 12 months, not what is necessarily going to happen in the future. This current drawdown in the EV sector is not destined to last forever. In my opinion, the market opportunity, the value proposition, and the sustainable aspect of electric vehicles is undeniable. Whether it be semi-trucks, pickup trucks, luxury sedans, or even three-wheeled vehicles, the EV transition is well underway. You can clearly see that with how successful Tesla's Model 3 and Model Ys have been when you really try to attract lower-tier customers, whether that be through more efficiencies, better product margins, more value proposition to the customer. There are a lot of avenues that EV startups can follow to increase their profit margins, increase growth, and raise money. The current drawdown we're seeing in the market, in my opinion, is temporary. Whether this means every single EV company on the public markets is going to survive, I don't know, and there is absolutely no guarantee that that will be the case. All I believe is that there is opportunity in the fire that we're seeing in the markets today. Tesla's market cap, for example, is $588 billion, whereas Rivian, Lucid, Polestar, and Fisker are sitting underneath $14 billion. This isn't necessarily to compare how much these companies could be worth in the future. It's more to compare the stock market's appetite for successful electric vehicle businesses. And don't forget, the auto industry is massive, and there are going to be more than just one player targeting a specific niche of customers, as we can clearly see with how successful Japan's Nissan, Toyota, and Honda have been. It's just a sad reality that in the short term, when interest rates hit 5%, people and investors are more inclined to invest in bonds, which are basically zero risk assets. And when you have so much enthusiasm around EVs, at some point the people that got trapped into these thinking they would make a quick buck are all of a sudden liquidating their positions, resulting in the stock prices that we are seeing today. The situation has gotten so dire, in fact, that some companies like Nikola Motors and Rivian are actually being worth by the market less than what their book value per share is on the balance sheet. Meaning investors are trying to price in these businesses going bankrupt and being liquidated being worth less than what they actually have after you subtract all their debts from their cash position. And even when you just look at the cash positions for these companies, they're starting to trade at pretty interesting levels. This is certainly an EV industry that's going to continue to evolve dramatically over the next 12 months. And although there's a lot of pain, fear, and fire in the market today, I think there is opportunity and true value that's going to be created by some of these businesses. But as usual, guys, it is just my take on this ever-developing situation. So let me know your thoughts down in the comment section below.